Welcome to the Financial Market Examiner YouTube channel, where you learn about Forex, crypto, and the stock markets. But on this channel today, we'll look at the exchange rate in the Forex market. You can simply get along your calculator with your writing materials, as we'll be exchanging foreign currency on paper. What is an exchange rate? An exchange rate is a rate at which currency will be exchanged for another currency and affects trade and the movement of money between countries. Exchange rates are impacted by both the domestic currency value and the foreign currency value. Let's take for example, the exchange rate from US dollars to the euro is 1.02, meaning it takes $1.02 to buy 1 euro. Important things to know about the exchange rate. The exchange rate between two currencies is commonly determined by the following factors. 1. Economic activity. 2. Market interest rates. 3. Gross domestic product. 4. The unemployment rate in each of the countries. An exchange rate are set in the global financial market space, where banks and other financial institutions trade currencies around the clock based on these factors. Changes in rates can occur hourly or daily, with small changes or in large increment shifts. An exchange rate is commonly quoted using an acronym for the national currencies it represents. For example, the acronym USD represents the US dollar, while EUR represents the euro. To quote the currency pair for the dollar and the euro, it will be EUR USD. In the case of the Japanese yen, it will be usdjpy or dollar to yen. An exchange rate of 100 means that $1 equals 100 yen. How exchange rate fluctuates? Exchange rates can be free floating or fixed. A free floating exchange rate rises and falls due to changes in the foreign markets. A fixed exchange is pegged to the value of another currency. The Hong Kong dollar is pegged to the US dollar in a range of 7.75 to 7.85. This means that the value of the Hong Kong dollar to the US dollar will remain within this range. Exchange rates have what is called a spot rate or cash value, which is the current market value. Alternatively, an exchange rate may have a forward value, which is based on expectations for the currency to rise or fall versus its spot price. Forward rate values may fluctuate due to changes in expectations for future interest rates in one country versus another. The traders speculate that Eurozone will ease monetary policy versus the US. They may buy the dollar versus the euro, resulting in a downward trend in the value of the euro. Exchange rate example. Mr. Emmanuel traveled to Germany from the US, wants 200 USD worth of euro when arriving in Germany. The sell rate is the rate at which it sells foreign currency in exchange rates for local currency. The buy rate is the rate at which it buys foreign currency from the travelers to exchanges for local currency. If the current exchange rate is 1.05, $200 will net 190.48 euro in return. So in this case, the equation is dollars divided by exchange rates equals to euro. $200 divided by 1.05 equals to 190.48 euro. After the trip, suppose 66 euro is remaining. If the exchange rate has dropped to 1.02, the change from euros to dollar will be $67.32. 66 euro multiplied by 1.02 equals to $67.32. The Japanese yen is calculated differently. In this case, the dollar is placed in front of the yen as in usdjpy. The equation for usdjpy is dollars multiplied by exchange rates equals to yen. If he travels to Japan and wants to convert $100 into yen and the exchange rate is 110, it would get 11,000 yen. To convert the yen back into dollars, one needs to divide the amount of the currency by the exchange rates. How do exchange rates affect the supply and demand of goods? Changes in exchange rates affect businesses by changing the cost of supplies that are purchased from a different country and by changing the demand for their products from overseas customers. What is a restricted currency? Exchange rates can offer within the same country. Some countries have restricted currencies, limiting their exchange to within the country's borders, or even there is an onshore rate and an offshore rate. A more favorable exchange rate can be found within a country borders versus outside its borders, and a restricted currency has its value set by the government. China is an example of a country that has this rate structure and a currency that is controlled by the government. Every day, the Chinese government sets a midpoint value for the currency, allowing the yuan to trade in a band of 2% from the midpoint. And finally, an exchange rate is a rate at which one currency will be exchanged for another currency. While most exchange rates are floating and will rise based on the supply and demand of the market, some exchange rates are pegged or fixed to the value of a specific country's currency. Exchange rates changes affect businesses and the cost of supplies and demands for their products in the international market space. We've come to the end of the video for today. You can find other videos on the financial market on our channel, and note that this video is not for financial advice but for educational purposes only. Kindly subscribe, share and like after watching. Thank you.